Once a giant in the energy industry, Enron Corporation dominated the markets in the 1990s. Headquartered in Houston, Texas, it became a household name, recognized for its success in energy, commodities, and services. But behind the scenes, a devastating collapse was brewing. Before its fall, Enron's stock price reached a stunning $90.75 per share. By the time the company declared bankruptcy on December 2, 2001, its stock was worth just $0.26. What happened in between? Let's uncover the dark truth. Enron's journey took a sharp turn in 1992 when they made a bold decision. The company, led by CEO Kenneth Lay and CFO Jeffrey Skilling, switched its accounting method to mark-to-market accounting. Unlike traditional accounting, which records assets based on their historical cost, the mark-to-market approach valued assets based on their current market value, an innovative practice that promised to reflect a company's real-time financial situation. But this method also introduced a dangerous loophole for manipulation. As the dot-com bubble inflated in the late 90s, Enron wasn't just focused on energy. It quickly expanded into other ventures, such as Enron Online, a digital platform for trading commodities. They also partnered with Blockbuster to venture into video on demand. With the stock market soaring, Enron leveraged its reputation and trading expertise to amass staggering amounts of business. But with the dot-com bubble beginning to burst in 2000, Enron's fortunes started to waver. Enron faced mounting losses as their investments faltered, but they weren't willing to face the reality. Instead, they turned to mark-to-market accounting to hide their financial troubles. For example, when Enron invested in new projects, such as power plants, they immediately reported expected profits that didn't exist. If the actual returns didn't meet expectations, they simply transferred the loss to special purpose vehicles, or SPVs, and kept the truth hidden from investors. Enron's CFO, Andrew Fastow, masterminded a system of special purpose vehicles, or SPVs, to keep Enron's debt off its books. The SPVs were designed to hold Enron stock and hide toxic assets, presenting the illusion of a financially healthy company. These off-balance sheet entities helped Enron obscure billions in losses. But this strategy was deeply flawed. When Enron's stock began to drop, the SPVs couldn't hedge their value, and the financial house of cards began to collapse. Enron's lack of transparency was compounded by its accounting firm, Arthur Andersen, one of the largest and most respected in the country. Despite clear signs of fraudulent activity, Arthur Andersen continued to sign off on Enron's financial reports. In 2001, as analysts began to raise concerns, Enron's stock started to plummet. The company's facade was crumbling, but it was too late to stop the fallout. As the investigation deepened, the full extent of Enron's financial manipulation came to light. In October 2001, Enron reported its first quarterly loss, and just days later it was revealed that they had been inflating earnings for years. The SEC's involvement forced Enron to restate its earnings back to 1997, revealing billions in losses. The company's stock plummeted, and by December 2001, Enron filed for bankruptcy. Enron's bankruptcy was one of the largest corporate collapses in history, with shareholders losing $74 billion. Legal battles ensued, and executives were charged with fraud and conspiracy. Kenneth Lay, Enron's founder, died of a heart attack before sentencing. Andrew Fastow, the mastermind behind the SPVs, served over 5 years in prison, while CEO Jeffrey Skilling received a 17-year sentence. Meanwhile, Enron's former accounting firm, Arthur Andersen, was convicted of obstructing justice, but was later acquitted on appeal. The Enron scandal led to sweeping changes in financial regulations. In 2002, the Sarbanes-Oxley Act was signed into law, establishing stricter penalties for fraudulent financial practices and improving corporate transparency. Enron's fall became a stark warning, prompting reforms across industries to ensure such a catastrophe would never happen again. While Enron no longer exists, as it once did, its legacy lives on. The scandal reshaped corporate America, with lessons learned about the dangers of unchecked corporate greed and accounting malpractices. Enron's downfall serves as a cautionary tale, reminding us that no company is too big to fail.